China has just fired a shot Washington never expected. With a single command, Beijing ordered every Chinese company to halt purchases of American chips, instantly cutting off the pipeline that fed U.S. semiconductors into the heart of China's technology machine. The reaction was immediate. Markets jolted, investors panicked, and in Washington, Treasury Secretary Scott Bessant, once hailed as Wall Street's golden mind, is said to be in full alarm. Donald Trump believed he had staged a masterstroke. By loosening restrictions, he allowed Nvidia to sell its newly tailored H20 artificial intelligence chips to China, convinced the demand would be unstoppable. To Washington, the plan looked airtight. China would line up for the processors, American corporations would cash in, and the Treasury would skim 15% from every deal. For Trump, it was supposed to be effortless profit, the perfect combination of technology, money, and leverage. But Beijing didn't bend. They slammed the door shut. Xi Jinping's government told Chinese firms not just to walk away from Nvidia's offers, but also to cancel orders from AMD, striking down two of America's biggest chipmakers in a single move. Then they took it even further, issuing rules that ban U.S. semiconductors from any state-funded projects. The signal was unmistakable. China will no longer live under Washington's thumb. This was never about whether the H20 was powerful enough, or whether U.S. chips still led in performance. It was about sovereignty. Beijing wanted the world to see that it cannot be boxed in, manipulated, or forced into reliance on American technology. What Trump framed as a victory has been spun into a public defeat, and the aftershocks stretch far beyond one deal gone wrong. For decades, U.S. chip giants built their fortunes on China's massive demand. Without it, their future revenues, their global dominance, and their grip on innovation are all in jeopardy. And the timing couldn't be more brutal. The United States is already weighed down by staggering debt, climbing inflation, and political division. Losing its most important technology customer now is like tearing the foundation out from under an already shaky house. This is no longer trade. It is a struggle over power itself, and at this moment, Beijing looks methodical and in control, while Washington stumbles through its own missteps. But this turning point didn't appear overnight. It was the inevitable result of more than a decade of American policies that backfired. For years, Washington's playbook was the same. Block exports, restrict access to advanced processors, and starve China of the tools needed to build its own cutting-edge chips. The idea was simple. Keep Beijing dependent, keep it behind. On paper, it looked like a winning strategy. But while Washington was busy writing bans, China was busy building an empire. Billions of dollars flowed into its semiconductor sector. Entire cities built industrial parks for fabrication plants. Universities expanded, training legions of engineers. Local governments poured money into startups working on chip design, lithography, and manufacturing gear. Progress was uneven, but it never stopped. And in some areas it moved faster than American analysts imagined possible. A gap once expected to last a decade was sometimes cut in half. Then Trump escalated. His trade war unleashed tariffs, blacklists, and sanctions aimed at kneecapping China's tech rise. But instead of crippling Beijing, it lit a fire. Suddenly, breaking free of U.S. technology wasn't just an ambition. It was a survival mission. China doubled its efforts, redesigning supply chains, pouring resources into alternatives, and turning dependency into determination. Meanwhile, Washington began to feel the blowback. U.S. tech titans like Nvidia, Intel, and Qualcomm relied on China for enormous profits, and those profits were vanishing. So Trump tried a pivot. He offered up Nvidia's H20 chip, a weakened product crafted to satisfy American export rules, stripped of key features but still valuable. To make the move politically appealing, he slapped a 15% tax on every sale, branding it as clever policy that would funnel money into the Treasury. Beijing wasn't fooled. They rejected it outright. Orders were canceled, partnerships dissolved, and the timing couldn't have been more deliberate. By then, China had already unveiled its own next-generation AI platforms like DeepSeek, systems powerful enough to rival Western technology. Its debut shook the industry because it proved the one thing Washington feared most. China no longer needed American chips to leap forward. And here's the sting. Nvidia's H20 wasn't even a full product. It was a compromised design, intentionally downgraded to fit U.S. rules. To Beijing, it was proof that Washington was trying to keep them on a leash. So they tore the leash apart. From Beijing's point of view, this was never cooperation. It was humiliation. Paying steeper prices for downgraded semiconductors while letting Washington pocket a cut didn't resemble partnership. It resembled dependency, with America manning the toll gate. So China drew a line. In a single decisive step, it halted U.S. chip purchases and turned the move into a demonstration of resolve. The message to Washington was crystal clear. Chinese industries will not stake their future on American processors. The message to the rest of the world carried just as much weight. China is prepared to stand independently and reshape the rules of global technology. This wasn't merely a quarrel over one product or one supplier. It was a signal of a broader realignment. For the United States, the ban was a sharp warning that the policy of squeezing China's semiconductor access had reached its ceiling. For Beijing, it was validation that decades of heavy investment, strategic planning, and relentless persistence were finally bearing fruit. The equilibrium had shifted, and it was happening in plain sight. America's reliance on China isn't a side note. It's central to the functioning of the modern tech economy. This isn't about marginal markets or minor contracts. This is about one of the largest consumer arenas and industrial backbones on Earth. A market so immense that losing it doesn't just dent corporate profits. It threatens to unravel entire global enterprises. Look at Apple. For years, China has been both a golden market and the engine of its supply chain. In 2023, nearly 19% of Apple's worldwide revenue flowed from Greater China, almost 1 in every $5. That figure isn't just about iPhones disappearing from the shelves of Shanghai or Beijing. It's about the vast web of factories, suppliers, and logistics that make Apple's famously synchronized launches possible. Should Beijing tighten the screws, Apple faces a double blow: collapsing sales in its second-largest market and potential paralysis in its manufacturing lines. And outside the US, no nation hosts more Apple stores than China. Nvidia, the poster child of America's AI revolution, tells an equally stark story. In 2022, almost a quarter of its data center income came from Chinese clients. Chinese research labs and cloud giants were buying tens of thousands of GPUs, laying the groundwork for their own AI breakthroughs. But Washington's export restrictions forced Nvidia to hobble its products, creating watered-down versions like the A800 and H20 tailored for the Chinese market. The result? Billions lost. Analysts say if sales had remained unrestricted, Nvidia might have added roughly $15 billion in revenue, money now gone. Qualcomm is even more dependent. Its chips power Chinese smartphone makers such as Xiaomi, Oppo, and Vivo. In 2023, China accounted for 64% of Qualcomm's total revenue. And these processors don't remain within China. They're shipped worldwide in millions of devices. Without that scale, Qualcomm would find it difficult to finance the cutting-edge R&D needed to remain competitive. Even companies less visible in hardware feel the squeeze. Microsoft maintains steady income in China through Windows licensing, enterprise software, and Azure services delivered via local partnerships. Tesla, though a car maker, is just as exposed. Its gigafactory in Shanghai is the anchor of its production empire, building hundreds of thousands of vehicles each year for both Chinese buyers and overseas markets. What binds all of this together is scale. China is not just another large customer, it is unique. Hundreds of millions of upwardly mobile consumers, colossal infrastructure spending, and corporate buyers able to place bulk orders that dwarf the capacity of other nations. That scale doesn't just expand revenue, it lowers costs and makes bleeding-edge products viable. Here's the paradox. Washington's talk of decoupling sounds tough, but the figures tell the truth. For America's most powerful tech giants, China is not a luxury, it is essential. If Beijing ever slams the door entirely, the aftershocks would hit corporate earnings and Wall Street indexes within hours. That's why attention has turned to Scott Bessant, not just another financial mogul. He built his fortune as a hedge fund manager and later became a political heavyweight. Now, as Treasury Secretary, he finds himself pulled directly into this standoff. He understands the stakes. Reports suggest Bessant knows the damage a Chinese ban could inflict on US firms. Nvidia, Qualcomm, Intel, already watching orders evaporate. Every lost deal strips away billions. For a man tasked with maintaining financial stability, this isn't just a problem, it's a full-blown crisis. Insiders whisper he has quietly searched for off-ramps, even probing ways to reopen channels with Beijing. But once China makes such a move, trust is shattered. Even if Washington strikes a short-term deal, Chinese companies will hesitate before staking their futures on American technology again. The shift isn't temporary, it's structural. That is the real danger. This isn't about one quarter's revenue. It's about the entire framework of global technology. Chips are the bedrock of everything. Phones, electric vehicles, medical tools, cloud servers, artificial intelligence, even modern weapons. If China can build an ecosystem entirely independent of American processors, the balance of innovation, supply chains, and influence could tilt permanently. That's not just about dollars. It's about power and the erosion of US dominance, and the world is watching closely. If Beijing proves it can swap US semiconductors with homegrown alternatives without losing efficiency or innovation, other nations and corporations will diversify too. Every step away from America gives Chinese firms more breathing room. Every shift erodes Washington's control. For decades, US supremacy in semiconductors was the hidden pillar of its global dominance. Now Beijing is probing just how fragile that foundation has become. Meanwhile, inside America, manufacturers are confronting a harsher reality. The flow of components, machinery, and raw materials is slowing. Costs are climbing. Shipments are delayed. Paperwork mounts. Production lines that once ran at full tilt now sputter. Managers cut hours. Plants scale back. Workers promised prosperity under the banner of Made in America now face shorter wages and empty factories. The promised revival looks more like bare survival. And this goes beyond China. The trade conflict has spilled over, straining alliances across Europe and Asia. Traditional partners long accustomed to U.S. leadership now hesitate. Tariff threats and erratic policy swings have left them skeptical. Can America still be trusted as a reliable partner? Increasingly, their answer is no. Quietly, they're constructing alternatives, regional trade blocs, parallel financial channels, new alliances designed specifically to bypass U.S. leverage. Once those new systems are locked in, Washington will no longer set the rules. That is the broader story. While Washington chases short-term wins, the world is already rewriting the framework of global trade without it. The danger isn't simply today's price hikes. The real danger is the moment the world discovers it no longer requires America to keep the system running. When that day comes, U.S. leverage won't just weaken, it could collapse outright. And so the question is no longer academic. Has Washington already forfeited its ability to shape the global economy? Or is there still a narrow path back before the balance of power slips away for good?